So welcome to Property Investing with Abi. On today's episode, we're talking about joint venture finance, how to raise private finance, and why is it that some people don't want to invest in property, but they're quite happy giving you their cash for you to invest for them to get a good return. This property we're in now is actually mine and Gordie's new house. It needs a full refurb and we're going to be putting an extension on it. But how did we buy this house, Gordie?
So we bought this house with joint venture finance. So I found an investor who loaned me £240,000 for a 12-month period. So that was enough to purchase this house in cash and plus do the refurb with it as well. So it was a good deal.
Yeah, we're going to be giving the investor his money back after 12 months because we need to refurb it, do a bit of the build, and then refinance it and pull our money back out, and then we can repay our investor. So this was a 12-month term, 240,000, and we gave our investor a really good interest rate.
Yeah.
Now, why did our investor want to invest with us? What do you think it was?
He is a property investor as well, but he's got a lot of other projects going on just now and he had some spare cash. So he knows what we do, he trusts what we do, and the money in the bank, the 240,000 was, well, losing money, wasn't it? So instead of him losing money every single month, day, year on that 240,000, he gave it to us. We've invested it in our own project and we're giving him a really good return as a deal.
And that's such a good point. In the bank, if the investor had kept the 240,000 in the bank, his bank interest rate was 0.01%. So with inflation, he would have lost money. So it was better for him to get it out that we could use it and we could give him a good return in 12 months' time.
And he's happy. He's happy.
We're thrilled, we're delighted because we get to, do our own house and do it as a buy, refurb, refinance. Where do people put their money nowadays to make a good return? We know in the bank it's not making a good return. What options have you got? Well, you've got property, you've got stocks and shares, you've got like Bitcoin, you can invest in business. We just stick with raising money and giving people good returns through property. Now, if somebody wants to go ahead and raise money, Gordie, how do they go about it?
It's a good question. It's a question that everybody asks. How do you raise money and where do you raise money from? Number one, you need to be credible. You need to understand what you're doing. I always say to people, you can't just walk out there, borrow £500,000 off someone to invest in a property if you don't know what you're doing. Because number one, that's ethically wrong. Number two, you're probably not going to be able to pay them back. So I work with a lot of investors. This investor is British, but we've got investors in Hong Kong, Switzerland, Dubai, Saudi from last week.
Yeah.
So most of my investors are UK and worldwide, but they just know me from Facebook. They know me from what I do in property because I post and put content out there about it.
So if you're on the other side of the fence, if you're thinking, actually I've got loads of money, I've been watching all this property, it seems a bit much like hard work, I'd quite like to invest my money and get a good return. How do you know when you're going to work with someone? What do you do? How do you mitigate the risks?
Okay, cool. So it's a good question. So the number one my investors want to know, what's the security? What's stopping you, Abi, running off to the south of France on a jolly? So we put stuff in place like all legal paperwork and contracts are all done through solicitors. So everything's legally binding. That's first thing. Second thing is we give them a charge over the property. So our investor for this project has got first charge over this property. So we can't run away with his money. If we did, he'd end up repossessing the property. So first charge is exactly what a bank's got over your property. If you don't pay your mortgage, they'll activate the first charge and then your house will end up being repossessed. It's the same thing.
This bedroom's going to be my 8-year-old son's bedroom, Thomas. So there is no roof. And we found that squirrels have been running around up there. And also we're having a debate with Thomas because Thomas quite likes this wallpaper. And we want to rag it out.
We're ragging it out.
We're ragging it out. So Gordie, give me the top pointers on if you're going to work with an investor, how do you vet them out? How do you make sure they're legit? And how do you know you're going to work with them?
It's a great point. What everybody thinks is that the investor's going to do due diligence on you, but you're not going to do any due diligence on them, which is completely wrong. So number one, I will never work with somebody that I don't get along with, because hopefully this business relationship that I've got with my investor is going to go on for many, many years. And if I didn't get on with them, it's going to cause some upset along the way. So number one, always make sure you get on with the investor. Number two, make sure that they do actually have the funds that they say they have. Please do not be scared to ask for proof of funds and certified ID. That's completely normal. And number three, make sure everything is done legally through the solicitors. Now, not all my investors choose to use solicitors, but they're always given the option to go and get legal advice on it. So you want to make sure everything's above board. You want to make sure the investor fully understands what they're investing in. They want to understand the risks, the upsides. They just need to know the full picture so you gain trust with them.
So thanks for that, Gordie. Next, if you are an investor and you're sitting with some cash, maybe 200,000 in the bank, how do you make sure that the person you're going to loan it to is safe, legit, and you protect your money?
It's a great point. So number one, they need to make sure that your company is real. So they would look up on Companies House and make sure that the company that's borrowing the money is actively trading. Number two, you need to make sure that the property is also real. So check it out on land registry or whatever you need to do just to make sure that you can make sure the money that you're loaning to the company has actually got a property to purchase it with. And number three, and I keep coming back to this, do it through the solicitors. The solicitors mitigate the risk. They do money laundering checks. They do everything for you. So number three, always do it through solicitors.
That is such a good point, because what you don't want to do is lend somebody 200,000, you sign a piece of paper with them, and then you realise you've got no first charge guarantee. Now, it's fine if you've agreed no first charge and you're going to get a really high interest rate. However, if you've got no first charge and something happens and they can't pay you back, you've got no asset to be able to repossess. You can't get your money back, which is huge. So you really need to be careful here. However, we know so many people that do this day in, day out. They make good interest, the property investor gets to invest, and it can be a win-win if done correctly. And that's why Gordie's saying, do it through solicitors all the time. Both sides will do all the legitimate checks so you can make sure you are safe. And do you know how much it is to go through solicitors?
No, because I never deal with solicitors, you do.
It's usually £750 to £1,000 on both sides. But for a deal that's going to make you, money or good interest for a year, I don't think that's too bad to protect you.
But here's the point, who should pay the solicitor fees? Because that's always the point people raise, because myself and you, we actually pay £800 towards the legal bill for our investors, don't we? So
yeah, we do. It totally depends how much interest you're paying. So we would normally pay our investors 6 to 6.5% to lend their money, and we would pay their solicitor fees, or we would put towards their solicitor fees up to a cap of about £800. I know people that pay higher interest rates, but they wouldn't pay the solicitor fees, or they want it for longer, or they're not going to give you first charge on the property. So you just make sure that you understand what you're getting and the fees there. It's always got to be win-win. So our project manager is awesome, and I really like what he does to show that he cares about me and the property. So what he does when he goes in places, he leaves kisses on the wall. So I don't know if you can see, he's left me some little kisses here. I've got some over there as well. So thanks, Paul, really appreciate it. So guys, I'm gonna go back to the office and I'm gonna show you some numbers on a flip chart, how this all works with if you're gonna borrow the full amount from someone and give them back in a year's time, or if you're gonna do what we call a corporate loan to their company. So I'll show you how them figures work. But first of all, Gordie, last words or hints or tips you would give the viewers about how to do this and how to stay safe.
Tips for me is just make sure you do everything ethically and fair. It's got to be a win for you as the investor, and it's got to be a win for me as the business person. So what I always make sure that both parties are getting exactly what they want from it. Everything's fully above board and everybody knows exactly where they stand, so there's no confusion going down the line. Just remember, you're using other people's money, so you need to make sure you're doing it very ethically, correctly, and pretend that you're using your mum and dad's money. Because when you pretend that you're using your mum and dad's money, your mindset completely changes.
There's two ways you can work with investors. You can do what we call like a straightforward loan, where you get first charge, like we've been talking about. So let's look at a scenario. Investor lends us 200,000, or if you're the investor, you're going to be lending that money. The term is 12 months, so you get your money back in 12 months, and you're going to get 6.5% interest. Now on that level of interest, your solicitor fees will be paid as well. So I'll just put solicitor fees. You get first charge. You're basically, in a year's time, you'll get your 200,000 back plus your 6% interest. Now 6.5% of 200,000 is 13,000. So you'll get 13,000 back plus your original 200,000. But that's your profit. And what's your job while you've been making this 13,000? Simple. Give the money, do the solicitor paperwork, you're done. For 12 months you sit back, and at the end of 12 months you get this back. So you get your original 200,000 plus 13,000. Now, let me go over to the property investors side. Hi, now I'm a property investor. Property investors, what are you going to do with that money? Well, I would take that money and I would refurb a house. Now, I know what you're going to say. I'm really good at drawing houses, aren't I? Look at that. I will take that 200 grand and I will do a buy, refurb, refinance with it. So I will purchase the house for potentially 150,000, 50,000 refurbing it. That adds up to be total costs, rough figures, 200,000. So my house, I know, because I'm an educated property investor, I understand how market value works. That house is now valued at 280,000. So what I do, now I've done it and it all looks nice and I might have had an extension or whatever I've done with it, I'm gonna get a bank to put a 75% loan to value mortgage on it. I'm gonna release 210,000. So what I can do is I can pay my investor back and I just need to add 3 grand into the deal. So my investor gets his original 210 plaque plus me from my own money or the business's money, I do it to pay the investor his 213 back. And that's how it works in business. So before you take the investor's money, you need to make sure you can do this. You need to make sure you've always got a fund. Ideally, because if I did it on an 80% loan to value, that's 80% loan to value, how much would I pull out? But at the minute, there's only really 75% loans to value around. So if I did it on 80% loan to value, I'd pull out 224,000, which means I could pay my investor back the 213, and then I could keep the rest of the money. So I get to keep 11,000. So it depends on a multiple factors. But the biggest thing is that's what I would do as a property investor. Let's have a look at now at another thing that's done in property quite a bit using investor monies called a corporate loan. Hi, I'm back being the investor now. So we're gonna look at a corporate loan. Corporate loans are not just done in property, they're done in business. You see massive businesses do this. People do this when they want, money to take their business to the next level. They get investment from investors. And what you can do is do a corporate loan. I personally work in 3 different ways. I offer a corporate loan on a 5-year term, 7-year, or 10-year term. And I do this for my investors. So on a 5-year term, I give them a 5% bonus every year that I've got the money. So they invest with me, they get a 5% bonus every year. And then at the time where I give them back the full money, at the 5-year point, I also give them a little something else as a thank you. I give them 2%. So 7-year, I do 5% a year again, and they get that paid every year on the dot, a bit like a loan. And then when I'm finishing the loan at 7-year point, I give them 8%. And the same for 10-year, 5%, 10%. So let's keep it simple. Let's say if someone wants to, if you've got 50,000 you want to invest and you use this setup, so I'll put 50,000 here. You're gonna get 5% of 50,000 every year. So you get 5% of 50,000, which I'm just gonna check because I normally get figures wrong. 2,500. So 2,500 year 1, 2,500 year 2, 2,500 year 3, 2,500 year 4, my writing's getting worse, 2,500. So you've had 5, 10, at 12,500 at that point, at this point already. And you then get another, because we've done it for 5 years, a 2% added on top. So if I do 50,000 times by 0.02. So the total profit you would make from investing 50,000 is £13,500. So the total you would make is 13,500. So that's from just putting 50,000 with a corporate loan, with a business or a property investor, getting paid yearly, and then at the end of it, you've made a total of 13,500. Which, let's do the return on investment for that. You've invested 50,000, you've made 13,500, you've invested 50. So over the 7 years ROI, oops, sorry, I meant 5 years, not 7, is 27%, which I think is quite good. If considering you get a bank, you get 0.01 to I think the highest is maybe 1.2% now. That's a very, very good return. Now, different people will do these differently and different businesses will do these differently, but that's what you're looking at. Now, if you're the property investor, why would you want to do that? So all of a sudden, you've got 50,000. You can then potentially go and buy a property worth 200,000 and you use a mortgage as well. So you'd use, there's my little house again. Oh my gosh, it looks a bit angry now. So you'd use a 50,000 as a deposit. You would then put a mortgage on the rest and you would be able to have an asset. You will have the 50,000 in for 5 years. Now, what do we know about property prices? They always increase. 5 years time, you can equity release or you can pull, do a new mortgage on it. I'll put remortgage, pull out the money and pay your investor back, and you're still left with a mortgage on here, but you're left with an asset that's giving you money. But that's a different way to do it. Now with both of these, again, you need to be very careful. You need to make sure you go through solicitors and make sure everything is legitimate, like Gordie was saying, those top tips. But doing it this way is a huge win for those people that don't want to become property investors. They don't want to do things, they've just got money and they like to invest money. And also for those people like me who love buying property and love every day, you know, people investing with them and being able to buy property. But this one's a great shout because you get an asset, you get to start making money from the rental income, and the rental income will go to pay this every single year, as well as you making a bit extra. So you're looking for properties where it's really good rent, and then again, you would remortgage in 5 years and pay your investor back. Now the difference is, with this one, you don't get a first charge. It's a loan against the company. Your guarantee would be the company and what's in the company. Whereas with this one, you get first charge, which is like bank lending. So if anything happens, you can go and repossess the property. I hope that's been helpful, guys. That's my quick 2-minute version. Obviously, there's so much more into this and you need to go and get educated about it and do it properly and learn. But that's just a very quick squiggle from my brain, how I work with my investors and how you could do too. Or if you've got funds and you're looking to invest, how you could potentially work with other people. So I hope you enjoyed it. If you haven't already, subscribe, like the video, comment below, and please don't tell me that my little houses and people look bad, because I think I've done a really good job. See you next week.